Welcome to Barchart's weekly series of webinars designed to help you, the investor trader, better understand a variety of trading ideas and concepts, as well as the pages and tools Barchart provides to help you to make a more informed investment decision. Today's subject, Long Strangle strategy. Now, I think it was Keats who said that nothing ever becomes real till it's experienced. And in my philosophy of trading, I believe that in trading, an experience accelerates your knowledge exponentially. The long strangle strategy is one of the more difficult option strategies to execute. It is, in essence, like trying to capture lightning in a bottle. And even if you are successful, your profits can quickly evaporate. So knowledge and experience can go a long way in employing this option strategy. Hello, everyone. My name is John Rowland, and Barchart's head of trading education. And as I said in the opening, this is a difficult strategy. Matter of fact, some of my more accomplished options trading friends call this the portfolio killer because there's a lot more scenarios that lead to losses than profits. So my goal today is threefold. First, I want to give you the theory and the risk behind the long strangle, offer you some ideas and hints for selecting potential candidates, and I'm going to show you two trade setups that I just recently laid out to give you a little bit of experience. With me today is my partner and our moderator, Barchart's project director, Gene Baker. Hello, Gene.
Good afternoon, John. How are you?
I'm doing great. And yourself?
I'm doing just fine here.
So, Gene, let me ask you, have you ever had a deja vu moment? You know, in other words, a feeling of already experienced the present situation?
Yeah, every Wednesday at noon, joining on these webinars with you, John. That's my deja vu moment. How about you? Do you have that?
Yes, that's a great answer. Yeah, for sure. That would be a great example of deja vu. Well, the long strangle strategy is definitely a strategy that can profit from deja vu of trading or experiences that we've had prior and looking to profit for them. But more about that in a moment. So first, let's see. Let me get it going here. Hello, everyone. Just a little business here. Today's session is for educational purposes only, and all trading investing has risks. Options trading is not suitable for all traders, and today's strategy could result in loss of principal. We at Barchart recommend that you consult with a qualified financial professional to understand whether options trading is suitable for you in light of your financial condition and your ability to bear risk. Under no circumstances shall we be liable for any loss or damages you may incur as a result of trading or investment activity based on the information or material received through barchart.com. Okay. So the long strangle strategy is a limited risk, potentially unlimited profit that looks for trades where the underlying is going to make a large price movement. I would add, a sharp price movement in either direction, or we're going to look for an increase in volatility. Now, we're going to look at equities today. I think that this strategy is probably better suited for futures markets because they tend to have greater volatility movements, but we'll look at equities today. A long straddle position consists of a long call that is above current price, referred to as an out of the money, and long a put that is below current price, again, out of the money. Both options have the same expiration date. And typically, we're reliant on a catalyst. And examples include, but are not limited to, corporate events like earnings or macro events. For instance, Fed announcements. But we're also going to look at pattern recognition and some technical analysis that could enhance one of these corporate events. Break-even, gain, and loss. Well, a break-even occurs at expiration if the underlying security is above our call or below our strike price by the amount of the total premium paid. Our maximum gain, again, is in theory unlimited, but to the downside, it is limited to the stock price going to zero. Now, although not a maximum gain, profits can be achieved if the price is above or below our strike range, or we see that increase in volatility. Our maximum loss is limited to that total premium paid, the cost of our long call and our long put. So what are some of the risks? Well, the dollar risk is limited, right? That is something that is fixed. How much does it cost for our put and calls? But there are other risks that could affect this strategy. And time decay, or in options, we call this theta, can have an adverse effect on our position. All options are wasting assets. So in other words, the passage of time has this negative impact on the price of our options. Falling volatility, sometimes referred as vol crush, typically that happens after an earnings report, is a killer to this strategy. Why? Well, because we have double the exposure to VEGA, or that volatility expansion or decrease, because we have two longs. If one side is in the money at expiration, typically a broker will exercise on your behalf. So you have to understand the rules of execution and exercise. All right, so while I'm on risk, though, let's talk about the scenarios that are the possible outcomes of, let's say, a long call, an out-of-the-money call. So if the underlying stock price fails to move significantly in either direction, that option is going to expire worthless. If the stock price rises slowly to our strike, but price expires at or near our strike price, again, this option is going to expire worthless. If the underlying stock price shoots past our strike, but returns to expire near our strike price, again, it's going to expire worthless. If the underlying stock price moves beyond the strike price and expires in the money, then this option will have values called its intrinsic value, the value of how much it is in the money. Now, that may or may not be enough to offset the original costs of this option. And so when we look at this strategy, in most likelihood, we're not going to hold this to expiration. And we're going to exit this trade when the strategy reaches a pre-designed profit threshold. Now, given the fact that we have 1 out of 4 scenarios that only ends with profit, and you can see there are 2 out of 4 that could be profitable at a given time. Remember, we are long a strangle, and it has 2 sides. So what's good for the long call is bad for the long put. And our cost is double because we bought two. This is what makes the strategy difficult and why we need to have realistic expectations to profitability. All right, so here's a setup, and I'm going to explain the reasoning behind the importance of the delta and the implied volatility and the percentiles as we go through the screener page, the Long Strangle screener page. But let's just kind of look through the process right here. So we have a stock that's trading around $610, and we're going to buy or go long the 640 call strike. It's going to cost us $9.20. We're going to go long the 580 put strike, and that's going to cost us about $9.80. So our net debit would be both of these added together, $9.20 and $9.80, and that would give us a net debit of $19. So in order for this strategy to be profitable at expiration, it has to be above the call strike price plus the net debit, $19, or we'd be in the money if it was above $659. On the downside, we take our put strike minus our net debit, $19, and again, at expiration, we would achieve profits below $561. All right. Okay, so I've gone to our options page, and under Strangle, here is the Long Strangle, and it screens out all potential opportunities looking at the equities market. And like all of our options strategy pages, you're going to get a main view, and the main view is going to give you the pertinent information that are related to this particular strategy, in this case, our Long Strangle. So what are some of the common things that you're going to find in the main view? Well, you got the symbol of your stock, the price, the current price, the expiration date of the options, your leg one strike. Notice that leg one is going to be our call. The leg one delta, the leg two strike. Notice our leg two strike will be puts. Our leg two delta, the net debit, the cost of this particular strategy. The percent of stock. Well, what does that mean? Well, it looks at the net debit, the cost of this particular strategy, and it relates it to the price of the underlying stock. So this was going to be one of those comparative tools for us in terms of finding potential candidates. Ideally, we want to have a low percentage of stock net debit cost, because that means that we have less of a price movement and needed for us to get a profitable trade. As far as putting a level, let me hold off on that in a moment. What is our average implied volatility? And then our break even, minus break even, our put side, and our plus break even, our call side. Now, we said that one of the components that could help with a long strangle is a catalyst, and that catalyst could be earnings. So again, we have a filtered view that tells you when the next earnings are. And so what we want to do here is, if I'm going to take a long strangle strategy, I want to make sure that my expiration date comes after my earnings. And so you can do that comparison right there. We also have a filter view, and the filter view will show you the filters or the inputs that we're using for this screener that have been designed for this page. But it's also going to show you those that we're going to add to our page that we could add to. All right. So let's go and look at some of those. Well, first of all, on this filter view page, the two that I really want us to concentrate on is days to expiration, our DTEs, and our net delta. And we'll talk about those in a moment as well. All right. Okay, so here is our set filters, and here's our default filters that are inside of our screener. And the first one is days to expiration. So let's talk about this. So we said that theta, that decay, is a killer to this particular strategy. So if we understand theta in terms of options, the theory basically goes this, that theta starts to increase, that decay is not linear, it's actually curved, and it starts to increase about 40 days out of expiration, and it really starts to accelerate 20 days out. So again, depending on our goals as traders, we might want to look at options that are a little bit longer dated, because then our theta will be benign. It won't be that affected onto our particular strategy. If I'm going to look at options that are going to expire inside of 40 days, then I know that theta is going to be greater. And so I want to make sure that if it is greater, then when I look at, for instance, VEGA, I want to make sure that that options volatility expansion is greater. But just bear with me on this one. Let's pretend for today, we're just going to look at only options that are outside of 40 days in a short window, 40 to 60 days. Now, the other thing that we've talked about in previous options sessions is this difference between weekly and monthlies. Now, I'm not saying weeklies are bad to trade, but we tend to see more institutional activity in monthly expirations. And that also relates to more volume and open interest, which could be beneficial to us for ease of us to get into these trades and to get out of these trades. So again, I'm just going to make a small minor adjustment, weekly expirations. I'm going to get rid of that. Probability, we'll just keep that the same. I'm going to slide this down. Net delta, we're going to look at delta legs. And here you can see that the delta legs is between 15 and 35 for the call and minus 15 and 35 for the put. Remember, delta is a relationship of how much our option will change with an increase of price of our $1 increase price of our stock. Now, again, the more delta we have, that's just telling us we're closer to current price. Option prices that are at the money will have a delta typically around 50. And so what we really want to do here is we want to find a kind of a sweet spot. We don't want to find legs that are outside of, let's say, a 10 delta, because we could still get a big price movement, but we're not going to get a lot of bang for a buck based on that option. And we don't want to get too close to that 50 or at the money, because then we're going to end up paying more for this particular option. So the sweet spot for this particular strategy is somewhere between 20 and 30. Not necessarily always that, but so in that range. So I'm just going to tighten this up just a little bit. I'm going to do 15 to 30. And then our net delta. Ideally, for this strategy, we want to have a net delta that is 0. In other words, we want the call delta to be exactly the same as our put delta. Now remember, the call delta is going to be positive and our put delta is going to be negative. We want to be as close as we can to 0. If I have a bias when I set up this triangle, let's say I have a bias that the market is going to break out, or the volatility, price volatility is going to go to the long side, then I can skew this delta towards the call side, a positive delta. Again, I don't want to be outside more than 5%, and then I'm going to get too skewed. And then again, if I felt that the bias was to the downside, I might allow the skew to move towards the negative. But ideally, we really want to have a 0 net delta. All right, so originally I think it was about 300 or 200 candidates originally on our screener. And look, we just made some very small minor adjustments here. And now we've lowered this down to 25 potential candidates. All right. And again, there's our days to expiration. You can see a lot of these are all December monthlies, and there's that net delta, right? Here is a net delta is pretty close to 0. Then that's telling us that we've got a nice neutral position. Here is a net delta that is close to 4, almost 5. And this is telling you on this particular option setup, you have a bias to the long side, all right? So let's go back to that main view, and we can again talk about our net delta as a percentage. And you can see that some of these now, the percentage of stock is very large. There's one here, the first one here is 16%. That's telling us we need a movement in this particular stock of almost 16, 17% to have a chance for some profitability. So we probably want to start thinking about lower percentages. Now, for me, again, every trader is going to have a different philosophy or discipline. For me, I kind of want to be right around 5% or below. Below would be good, but 5% is kind of my threshold. Now, if it's above 5%, then I'm going to look at that volatility equation to say, am I taking on more volatility? Is that going to be worth it in terms of the price that I'm going to have to lay out, the net debit, and do I believe that this stock has more volatility that will allow that price movement to occur? All right. So what are some other filters that we can put in to help lower some of our candidates? I'm going to come back in here. I'm going to go to options overview. And the two that I'm going to add are implied volatility rank . And the theory behind this is we really want to find those candidates who have a low rank and a low implied volatility percentile, because it's going to do two things for us. First of all, the lower the rank, the lower the volatility is going to help tighten the strikes for us. And when that tightens that strikes up, that means, again, less of price movements for us to have a potential of profitability. The other thing is lower volatility also translates into cost, and we'll discover that in low volatility candidates, then our cost will be much lower. So I'm going to add implied volatility, and now I don't want greater than, I want to do less than. And let's look at those candidates whose IV rank is in the bottom third of the implied volatility for this stock over the last year. And we're going to do percentile. And I'm going to add that. And again, I want to be less than, I want to be on the bottom half on this one. We'll get a little bit wider window for this one. Let's say in the bottom half. And let's see what our results are. Not only knocked it down by 4, but at least now what we know is that the candidates that we are looking at have already jumped through a lot of criterias for us. So what could be our next step to finding these likely candidates? Under the dividends and earnings, we could come back and look to see which one of these is going to have an earnings event prior to our expiration. And first, you can see that right off the top here. Was that Viacom, I believe, and you have Coca-Cola, which is having its earnings. I think it had its earnings actually announcements this morning. So this would be one of those potential candidates for us. The other thing we can do is we can start using some technical analysis from a technical standpoint. So I'm going to go to my flip charts. Now, on that page, we had 21 different setups, but notice that if you look up here, it looks like we only have maybe about 15 different stocks. That's just telling us that some of the stocks might have given 2 or 3 potential setups. And what tools can we use to help us in determining potential stocks that could be ready for some kind of a breakout or increased volatility? So one of the things we're going to look for is we're going to just eyeball this, and we're going to look at to see what stocks have come into what we can call a coiling or consolidation. In other words, price movement has moved and now it's kind of slowed down or is getting more range bounds, is getting ready to build energy, gathering energy to break out. And we could just kind of eyeball it. Here you can see, for instance, here on Viacom, this would have been an area where we would have been coiling, gathering energy as we're getting to break out. So it's already broken out, so this might not be a great candidate. Now, we do have a technical analysis tool that will make this visualization a lot easier for us. And that is called Bollinger Band. So I'm going here, right click, and I'm going to add studies. And I can just type in Bollinger Band. And I'm going to add Bollinger Band. And the theory behind Bollinger Bands, there's a couple of theories in here. First of all, the one that we're going to look at is that bands go from cycles of contraction to expansion. And when they come in together, when they narrow or they coil, this is an indication that our stock is building energy and is ready to break out. And you can see for Viacom, our outer band and our lower band here had gotten narrow, and that would have been an indication to us that this stock is getting ready to make a move. In this case, it was at the lower end of our band as it was narrowing, the bands were narrowing, and that was telling us that there was a high probability not only is this going to move, but it's probably going to move to the downside. The other theory behind Bollinger Bands is as our market breaks out, we will see our Bollinger Bands widen, and that's a confirmation that our volatility is going to increase. Typically, what we'll see is a lot of times the market will move from a lower band to a higher band. What we want to do is we want to kind of look at our stock price in terms of the charting capabilities of this coiling or consolidation, and in terms of our trends. In other words, you can see Viacom was kind of in a sideways but trending lower, and what we wanted to see is this narrowing of the band as price is moving from high to low, or from the mean to the outer band, and that would be an indication of increased volatility and price action to the downside. Now, there's another tool that is related to Bollinger Bands that kind of will do this process for you. this visualization process. Again, right click. And again, I'm just going to type in Bollinger Bands, and that's called Bollinger Band Squeeze. Now, what the squeeze does, it gives us this little line and allows us to see this in terms of a relative to other times or other band widths or band squeezes, or as our Bollinger Bands are widening and narrowing. And so for what we want to do is we want to look for when our band squeeze is relatively low. And again, you can see here as our market is moving from the median to the lower band, our bandwidth was very, very narrow, our squeeze, and now we're seeing that price is falling, but our bandwidth is widening, again telling us that volatility is in this particular stock. So I've created a template that's called Bollinger Bands, and that has our Bollinger Bands and our squeeze. And so this is kind of what I'm talking about. This is how we can kind of eyeball this very quickly in our flip charts. You just go through a lot of these stocks and look for those that have low band squeezes, and I look at the chart itself to see if we're looking at a potential breakout or a correction of a trend, or one of those other technical components. For instance, here's Coca-Cola. Yeah, our band is kind of wide, right? We're in our squeeze is up here. We want to find it when it's down here, narrower. Microsoft just recently had a big movement to the upside yesterday based on earnings announcement. Here would have been maybe the opportunity. This would have been a better opportunity looking for increased volatility. Now, it doesn't mean that that still is a good trade setup. We can still do that other process. Citi, right? Again, notice now this is more interesting to me because my bandwidth is very narrow, and Citi looks like it's been range bound, has been gathering energy, and it looks like it's starting to break out to the downside. And I could go through a few more of these. Again, JP Morgan, this is a great example of what we don't want to look for. We have a narrow low band, right? But our stock has been rising here, and we've reverted back to the mean. This could mean that our bands are a little bit wide here to begin with, and we might just stick in this range, or we could go from high to low, but maybe not enough to warrant a long strangle. All right, let's see if it's funny. Let's look at Apple. Some of these pop in and pop out. All right, so here again, we have our narrow band width, and what is our stock price doing? Well, it's gone from finding support, been in this range, and then here's that breakout day where we broke out of this range that Apple had been stuck in, and that it was showing us a potential increase of probability. The other thing we could also talk about, again, in this process, we could just right click, go to events, and see if earnings is on the horizon, or if earnings has just sent one of these stocks on its way. All right. So that's kind of the technical aspect of what we can do to help us find potential candidates. But I also talked about this experience component, that what makes this strategy kind of difficult to do. So I'm going to go here to ALCOA, and this is one of the stocks that I have in my portfolio. Full disclosure, I'm always trading in and out of this one. I've been trading this one for decades, and I really know this stock. I really know its behaviors. I know its nuances. I know its average true range. I know that how it cycles, how it comes in these cycles of consolidation, and then when it starts to break out, how much is it going to break out? And what I did was, about 2 weeks ago, I had noticed that we were coming into an earnings cycle, and ALCOA was kind of stuck in this range, right? This range. And, our prices were getting narrower, right? Our range of daily narrower, right? It's telling me my market is cycling, it's consolidating, it's coiling, it's getting ready to make a volatile move one way or the other. I didn't know which way it was going to move. Again, if I use my Bollinger Bands, right, you can see that our bands were narrowing, where our bandwidth had reached kind of a historic, in terms of relative narrowness, and it's telling me that market is getting ready for a breakout. So I look at this trade, it was about a week out, and on the day of the earnings, I just went through and looked at the values. So in this trade, I looked at the $45 put and the $55 call. And on the day before earnings came out, the $55 call was trading $2.13, and the $45 put was trading $2.63 for a total net debit of about $4.76. Now, the next day, the earnings came out, and they blew out their earnings. And they also talked about a dividend, and also talked about a $1 billion or $500 million buyback. And you can see ALCOA shot up. And in the 2 days after the earnings, the strangle went from $4.76. Well, the call went to $5.62, but the put went to 71 cents for a total net of $6.59, or a gain of about $1.83, a 38% profit on this particular trade. Now, notice what happened. In a very short period of time, the market fell back down, and it's moved from a 17% price movement to the upside to a 18% price movement to the downside. Now, again, one of the things I can do when I look at my stocks is I can go into my options overview and look at those implied volatilities and those percentiles. And one of the things I did say to you is that typically prior to earnings, we do see an increase in volatility. You can see our volatility was high, and I also can see what my IV rank in percentage. Now, in this case, I'm more familiar with the stock, so I'm willing to take on a little bit more volatility and take on a little bit higher rank and percentile. But notice now that our vol did fall, even though we went 70% up and 18% down. The other thing I can do is, let's go and see what this trade is worth today. And because we're looking at both calls and puts, I don't want to stack it. I'm going to do a comparison side by side. And since we're going to be jumping around, let's make this our default. And so let's go. Oh, by the way, this was I looked for a longer dated option. I did the December monthlies. I apologize, I didn't mention that in the beginning. And our $45 put today has a theoretical value of $2.92. And our $55 call has a theoretical value of $1.13. So what's that? $3, $4.15, $4.05. $4.05. Original cost was $4.70. Here's what makes this strategy difficult, right? Even though we've had an increase in price movement volatility, we still got crushed by the vol. Now, some of you might say, well, John, you could have exited that trade when we got that 38% profit. And I would say, yeah, that would have been a good strategy. Or some of you might have said, hey, why didn't you use a shorter dated option, right? Maybe one that was only 2 weeks away. And yeah, if I looked at that one, again, that one would have given me a greater profitability in this one price movement under the upside. But by the end of the week, that option was worthless, right? And the other thing to remember is it took a 17% price movement in ALCOA to get me to that 38% profitability. So what I did was for today is I went back, setting up for today's session, went back and looked at the earnings and dividends page. And what I wanted to do was I wanted to pick a stock that was going to have its earnings today prior to the opening. In other words, so we can look at the results, give you guys a little bit more experience. And here are a lot of the different stocks that have their earnings that came out this morning. Kraft Heinz, I was looking at that. Coca-Cola, Old Dominion. And the one that I went through the process was this Thermo Fisher Scientific. And that's, if I go back to our setup, this is the one that I set up for you. Again, now that we have a little bit greater understanding, right? This trade set up, and I did this one as of last Friday, anticipation of this event today. And our V rank was 14 or about 15. Our implied volatility was 25%. And our net cost was $19. Now think about this in terms of a $610 stock. Well, $20 goes into 600. What's that, about 3%? So it's a little bit less than 3% of the cost of the stock. Plus, I look at my deltas here. I'm trying to get inside that 20-25 range. Notice that we do have a slight bias to our call, and that's okay because I like this stock. It looks like it's trending higher. The other thing that I like about this technically, and we'll go to the chart in a second, is it looks like a technical formation that I'm familiar with. Again, experience that I believe the market is going to break out. But I'm willing to take this delta skew towards the call side because I believe the market is going to move higher. So if I go back to, here's Thermo today, and let me go to a little bit. Well, first of all, let's talk about the technical formation I'm talking about. And technical formations that when we are here, we get that consolidation, we're gathering energy. Not only are we gathering energy, we're consolidating right near an all-time high. And this is what is called a cup and handle. This is a very bullish technical formation. Now, let's look what this did this morning. This is a 1 hour chart. I'm just showing you a daily chart. The earnings came out and boom, yeah, we did get this big explosive movement in our trade. And so again, the technicals worked out. Let's see if the strangle worked out. So again, one of the reasons why I picked this one for an example, right? This one in terms of my IV rank and percentile, in terms of implied volatility, as well as you can see that this has kind of been a steady eddy. I didn't see this increase in volatility as we were leading up to the options, excuse me, the earnings. And we do have, you know, a relatively low rank and percentile. So that's why I picked this one. And let's go and look at what's going on right now. And I said again, I picked that December. And our 580 put is trading theoretically is worth $7.80. And our 640 call is trading at $10.70. Now that's right around our $19, right? A little bit less than that, right? $18.50. Now let's go back and look at options prices. And market is kind of moving in fluid today. Again, let me stack these in terms of highs and lows side by side. But when that earnings first came out, I'll make sure I'm in the right expiration. Yep. You can see, am I in the right expiration? Hang on, this one. Yeah. You can see that our option, call option, was actually worth $12.60 early in the morning, and our put, let's see what the low on that one was $7.74. So $12.60 plus $7.74, just a little bit over $21. Okay, right around $21. So this did give us a profit on the opening when the earnings came out. All right, let's go back to the stock chart. And we'll look at our Bollinger Bands. And again, you know, not an ideal Bollinger Band situation, but why I liked it was this consolidation on the upper band in an uptrend. And you can see that our bandwidth was not historically narrow, but it was bottoming and starting to show potential explosiveness in terms of volatility. So there are other technical analyses that we can look at. And one of the templates that I have created, and I've done this for another webinar, is looking at RSIs and MACDs. These are momentum indicators. So let me do this first. I'm going to move my MACD up a little bit. I'm going to keep moving it up. I'm going to move my RSI up. Puts my volume at the bottom. And what we kind of want to do here is, we're going to look at, if I'm looking at this strangle setup and I find a candidate that I like, again, I kind of want to see that increasing momentum, again, price momentum. Is my MACD crossing over? Is my RSI rising as my market is gathering energy, right? That's actually a positive sign for me. And if I put back in my squeeze, right? Here's our rising RSI. Here's our flattening, rising squeeze. Here is that crossover on our Bollinger Band that's telling us we're gathering momentum to the upside. So here you're using these three different technical analysis together. All right, let's go back a little bit in history here. Right, again, narrowing of bands as we're getting ready to break out of a range. Here's a narrowing of bands as we're getting ready to break out of a range on rising RSIs and a positive crossover in our MACD. So this is another technical analysis that you can use in finding those good candidates. All right, so again, before I move away from this example, I wanted to kind of just again reiterate this importance of VEGA versus Theta. And even though we are, let's go to our December, still outside of 45 days, and you can see here that our 580 put, right, here's our Theta is about 16 and our Vega here is 68. Again, I want to make sure that my Vega is a lot greater than my Theta, right? In this case, it's almost what, 4 times it, 3 times it, 3.5 times it, right? If I went to, for instance, a shorter monthly, right, one that is only 23 days out, again, if I look at that 580 put, right now my Theta Vega is only 2 to 1, right? So I could get a big price movement, but that Theta could be eating into my option. If I go back to ALCOA, this really kind of plays out. Right now, our $45 put, right? We see our Vega Theta is about 2 to 1, even though we're out to a 12-month option. But if I look, let's say, at a shorter term option, some of you said, hey, you should have used the shorter term option in this example. Let me just go to the 1st November weekly. Here you can see our Theta is 8, or is 0.08, and our Vega is 2. In other words, our Theta is a lot greater than our Vega. So we're not going to get a lot of appreciation in our option because it's going to decay a lot faster than any kind of volatility that we could appreciate from. So again, in doing this strategy, we really kind of want to look for those setups that have greater Vegas than Thetas. All right. I see a couple questions popping up. Let me answer a couple of these questions before I give you guys some takeaways.
All right. And
so,
while John reviews those questions, I'm going to take a moment to just tell everybody that the option screeners that John's looking at today are part of our Barchart Premier membership. If you are not a Premier member, we do offer a free 30-day trial. So get in there, sign up for a trial, take a look at these option screeners and specifically the strangle that he's been going through today. Okay, John, back to you.
Thanks, Gene. Yeah, I think there's a lot of value in just the option screeners alone. You find one decent trade, not necessarily the long strangle, but there's other trades, other option strategies in there. One good trade will pay for your subscription if you execute it properly. So a couple questions come up. One of them I see is a question is, if I have a long strangle or straddle and the position goes in favor, could I close out the unfavorable leg and ride out the favorable leg? And so, yeah, you could do that, but let's think about your trade plan. Your plan was to take this on as a strangle, 2 legs. Now, think about that scenario with ALCOA, right? Market shot up, the call was very favorable. You took off the put, and boom, the next day, that call went from being worth $5 to only being worth 70 cents, right? So then not only did you lose on your put, you took a loss on that, but then your call becomes worthless. So it's important for you to stick to your plan, right? So what you could do though in that scenario, if you had a favorable condition and you wanted to ride the trade out instead of not taking profit, closing out both legs at the same time, one of the options you could do is maybe roll up the unfavorable leg. In other words, in this case, we would have sold out the $45 put and rolled it up to a $50 put. Now that increases the cost of the trade. Or we could have rolled it all the way up to our $55 strike of our call and then made it into a straddle. Again, that will add more cost to the trade. Or I could take the loss on the unfavorable leg and then sell, in this case, in the ALCOA example here, as it rises up, sell a call above my 55 and create a vertical spread and locking in that profitability, again, limiting the profit, but also locking in some of those gains as well. All right, so that, again, I think if you set a trade up as a spread, in this case, a strangle, then take it off as a strangle. So Ted asks, isn't the cost of an option, money option is higher? Isn't the required stock movement about the same? Ted, it really comes down to the percentage of the stock price and the volatility of that particular stock, right? So yeah, you could have, in theory, a stock that has a net debit that is costs a lot, like the example I did within thermal, but you don't need a big price movement because the volatility is low. So it is a give and take there in terms of understanding that process. So the question here is, how can you tell the direction a stock is going to move in a Bollinger Band? So not necessarily the Bollinger Band is going to predict where price is going to move. It's just alerting us that our stock has come in from volatility and is coiling and getting ready to break out. The process we need to do is look at what our chart is doing, right? Is our market in a trend, right? For instance, here, right, we're outside the Bollinger Bands. That could say that we are beginning to move lower. But if we look at our trend over a longer period of time, right, it's just telling us that the market was a little bit oversold or had corrected, coiled, and it was ready to break out to the upside or move to the upside. So I think trend analysis is important when you do Bollinger Band analysis. Again, looking at our charts, see where we're coiling and if we're going to break out of a trading range. I think that's more important in terms of defining which way the price is going to go. Now, if you break out of a Bollinger Band coiling session and the bands start to widen and then you see confirmation in terms of your price action, right, an uptrend and widening coins, that's more significant. That will tell you that that trend is starting to really pick up momentum and it could carry on for a longer period of time. So Kim asked the questions for the ALCOA strength. Couldn't you have sold the call when it went into the money and then later the put went into the money? Well, again, there's no guarantee, Kim, that the put would go back into the money, right? So, but you could sell out the call, take those profits, and then roll the dice on the put side. So yeah, you could have done that for sure. All right. Okay. So I'm right at the top of the hour, right, Gene? So let's talk about some takeaways. Okay. First, awareness of a price catalyst. Now, that price catalyst could be a corporate event or a broader market data, for instance, earnings or a Fed release. But we could also look at catalysts from the technical standpoint in terms of, is our stock in a cycle of coiling or consolidation? Is it gathering energy? Is it getting ready to break out of a significant level? Is it going to regain a trend that has already been established? And that's what Bollinger Bands will help us to decide. We'll look at candidates that have low ranks and percentiles, because this does two functions for us. Lower the rank and lower the percentile, they'll lower the cost, lower the volatility. Also, it'll also narrow our bands of our strikes, and that will mean that we need less price movement to gain profitability. We're going to look at longer dated options, because longer dated options, the theta is going to be benign. It's not going to be that destructive to this position. And we'll find greater VEGAs, right? If we do get a price movement, that'll help us gain profitability. And we're going to look at that small net debit, right? Again, I want to see that in terms of percentage of my stock, and that means also less price movement in order to gain profitability. And finally is we need to be realistic about this particular trade, right? We're not going to get those home runs we'd find in some other trading opportunities, right? Remember our probability scenarios. 1 out of 4 is only going to really work for us. And again, we're not going to hold this to expiration. So I think you can think about anytime you get a threshold above 20 or 25% profitability, that might be an opportunity for you to put in place other parts of your trade plan, either to take the trade off, or again, like I talked about, rolling it up or turning it into a vertical trade. All right, so where are we at, Gene? Okay.
Just about at the top of the hour, right? We've already talked about taking a free trial for Barchart Premier, but John, why don't you talk about next week's session?
Yeah, so I went into tools in our webinar section, and so here you can see that next week's we're going to talk about the MACD oscillator, and we have a page under stock market ideas, the EMAC buy signal, and we're going to dig down into this one. This is a great tool. I showed you kind of how using MACDs to help us to confirm in terms of the Bollinger Band and also candidates for the strangle. But this is by itself, this is a really good signal. So we have a page that's designed based on the buy signal of the MACD. So we're going to go into talk about the math of MACD, what is the theory behind MACD, and we'll go to this page and look at candidates, look at trading opportunities, and in this case, look how to maybe narrow down some of these candidates to find some really good potential trade opportunities. So I think also, Gene, maybe we'll want to also mention that our webinar page has been updated, and there's a lot of cool things that we can find, and there are archived webinar, and you can see right at the top is the one that we've done today. So if you want to come back and watch this, you'll have an opportunity. That will be available sometime this evening. And is that correct, Gene?
In a few hours. Give me a chance to get everything out there. John's slides that he used today will also be on that page. If you click that Watch Now button, yeah, eventually you'll see the video out there. And if you attended today, you're going to receive an email letting you know the recording is available for you to watch.
I think it'll be up here. It'll say something about
slides,
right?
Correct.
Okay, great. Okay, anything else, Gene, did I forget?
No, just that I'm looking forward to next week's session. It's going to be a great informational session. You're going to get a lot of great ideas on things to look for. John's going to show you how to use some of the free tools on the Barchart website to go through and look at those strategies as well.
Okay, guys. Well, I hope you guys enjoyed today's session. I want to wish you all be safe out there, best of health, and the good of all trading.
Thank you again, everybody. We do appreciate you being with us at barchart.com. Have a great week and hope to see you again soon. Bye now.